All right, so today's question is a comparison between a Roth versus not Roth kind of tax buckets investments. So, for example, do I want to put money in a pre-tax manner or a post-tax manner? So I think it's a common question. A lot of people ask that. So I'm going to try to break it down into different parts of it and see if we can make sense out of it. So first of all, if you are new to the channel, then please don't forget to subscribe. So that way you get to know all the new things that are happening here, all kind of questions. And if you want to submit a question to me, you can simply WhatsApp me at 888-260-0017. Send me a WhatsApp with your question, and I'll try to get an answer out to you on through video at least. Or if you want to set up a personal consultation, you're always welcome to do that. All right. So the question is, I currently contribute 15% of my gross pay to my 401k, and my employer matches 25% to 75% on the first $10,000 of contributions based on company performance, meaning it's not guaranteed. If the company does well, they will contribute 75%. So of 10,000, meaning they will basically give you $7,500 worth of free money. And if company doesn't do well, then they will give you, I guess, 25%. Should I make pre-tax contribution or opt for Roth contributions? So first of all, I tell my clients is that we need to start looking at all of these options as different vehicles or different buckets, and each bucket has its own advantages and disadvantages. For example, Roth, we all know you put money in Roth with your post-tax money, and it grows completely tax-free. Versus in pre-tax manner, you are choosing not to pay tax right now, and you pay tax on the full amount later on. But this one had a third component to it. The third component is that you're getting free money. It's not guaranteed. It's based on company's performance. But the way I'm reading the statement, I think at least 25% is guaranteed. I think they're saying minimum will give you 25%. And if company does well, we might increase it to 50% or 75%. I think that's what they're really trying to say here. So even at 25%, that is free money. So first of all, whether I do it through Roth or I do it through non-Roth, I would at least try to capture the full contribution of my employer. I would not leave that on the table. That would be my first choice. Second thing I would like to consider is what kind of tax bracket you are in right now and what kind of tax bracket you will be in future. For example, if you are in a higher tax bracket today and you'll be in lower tax bracket in future, then it makes sense then you do it pre-tax, right? So that way you save on taxes today and you save on taxes tomorrow. Versus if you are in a lower tax bracket today and you can have a possibility of being in a higher tax bracket in future, then I would consider it doing it through Roth. Another thing to keep in mind is whether you put it in Roth or regular 401k, one day you have to take distributions. So when you have contributions that are not Roth, you are required to minimum distributions, required minimum distribution, commonly known as RMDs. And I think current age is 72. But in Roth accounts, you are exempt from them. So that's another thing to keep in mind. So that's my thoughts on this kind of question here. But I think the main point you should really pay attention to is that there is free money from your employer. No matter what, you should not leave that on the table. Now, normally when I do like a bigger consultations, like comprehensive consultations that are, usually 6 to 10 hours long, we look at Roth conversions, we look at Roth contributions, we look at Roth distributions, all kind of numbers to kind of figure out what is an effective Roth strategy. You'll be surprised how little numbers can make a big difference. So if you are, heavily putting your money in 401k, Roth, and you're curious as to how that would look like in your retirement ages, then definitely set up that comprehensive consult and we can dig deeper into that.